Let's bring on our next presentation. Bill Korn, there he is. He's the CFO of Care Cloud.
Hi there.
How are we doing today?
Doing well. How's everybody else doing?
We are doing well. It's Wednesday. The weather is turning. It's going to be fall. It is fall. And
gorgeous sunny day here in New Jersey.
Where in New Jersey?
Basking Ridge, New Jersey, about an hour out of New York City.
And I'm from East Brunswick, so not too far away. All right, let's get Bill's slides up on the screen. There they are, and I will see myself out of here. Bill, the floor is yours.
Great. Well, thanks everybody for joining. I will tell you a little bit today about CareCloud, and CareCloud is a healthcare technology company. We went public in 2014, so we were a little small when we went public. We were about a $10 million revenue company at the time. This year, our guidance is over 135 million of revenue, so a little bit of growth over the time that we've been public. Today, we serve roughly 40,000 healthcare providers who leverage our technology and services. Those providers. About half of the revenue comes from large physician groups. About a quarter comes from smaller medical practices, 1 to 5 doc practices. About 20% comes from hospitals and health systems. About 5% of revenue through industry partners. As I mentioned, we've grown pretty significantly. I think we've grown over 25% a year for each of the last 5 years. Something that's probably not as common for public NASDAQ listed companies, but we're very proud of that. When you think about what does CareCloud do, fundamentally we're helping doctor practices in the marketplace today. We help them with the economic problems of how do you submit the claims and get paid. With the regulatory, make sure I'm complying with HIPAA and MACRA and all the various government regulations. We help them essentially transform to the new digital economy. I mean, we all know what the world's gone through over the last 2 years. We introduced telehealth at the end of 2019 as part of our platform. So it was just sort of coincidence that when COVID hit, we were able to tell our doctors, guess what? There is a telehealth solution. It's built into your EHR. It's built into the patient portal. It's HIPAA compliant. It's already integrated. You can do telemed visits immediately. So that meant that we went from maybe 1 out of every 1,000 encounters being telehealth in 2019. To 40% of the encounters going telehealth in the middle of last year, and even today, roughly 10% of it is telehealth. From our perspective, we're sort of indifferent. We want to have we want the doctors to have the tools that they can run the visit however they want to, and however the patients are comfortable. When you think about our technology platform. Before the last couple of years, as our company evolved, we built a cloud-based platform. Our founder's wife was customer number 1. She's an internist in a solo practice. So we initially focused on the small 1 to 5 doctor practices, giving them software that was easy to use, easy to learn, so that they could really focus on the patient. And that includes the practice management software that's used to schedule appointments, check insurance eligibility. It includes the electronic health record that you see doctors use to take notes during the visit. The patient experience management that lets the patient schedule an appointment, check on the notes. So we developed a full suite of software. Last year, in January, we bought a company. And back up, when we went public, our name was Medical Transcription Billing Corporation. And even though we had software, probably 80% of our revenue was coming from the services side. So the billing services, which we call revenue cycle management, essentially submit claims for the insurance, make sure that the doctor gets paid, and then we get paid as a percent of what the doctor collects. We bought a company last January whose name was CareCloud. We liked the name well enough that we actually adopted that name. They'd also developed a technology suite. They spent over $100 million in venture capital to develop the technology, and they built a very robust state-of-the-art suite designed for bigger practices, more complex workflows. The good news is our solution initially developed was cloud-based. Theirs is cloud-based. The two solutions were very interoperable, so we started connecting them. Literally last March, we took our telemedicine app, connected it into their platform. So now we've got both a pro version for the complex workflows and the bigger practices, and a light version for the small doctors. All fully cloud based. In addition, we offer services, and our view is that for most doctors, the ability for us to offer technology and services together is worth a lot more than just giving them the software and asking them to hire the people to do all the work. In terms of our growth, we have traditionally grown through acquisition. The day that we went public in 2014, we acquired 3 companies, helping to get to a scale that made sense being public. When we bought CareCloud last year, they had a very strong organic sales and marketing team, and we've embraced that and used that to ratchet up our organic growth. So we probably quadrupled the amount that we were spending on sales and marketing last year, and we're probably going to grow that by another 50% this year. So we're now generating high single digits in terms of organic growth. And while that sounds good, candidly, even if you got your organic growth to 10% a year, the math says it still takes 7 years to double in size. We doubled in size last year by doing acquisitions. So we feel that organic growth is good. It helps to make up for doctors who retire or sell their practice. But the way that you keep on doubling is by doing game-changing acquisitions. And we've also recently started doing partnerships. When we see somebody and they're too small to really make sense to do an acquisition, we can let them leverage our technology and leverage our services by forming a partnership, essentially white labeling our capabilities. And we've done that a number of times over the last year and a half. The most recent acquisition that we did, a company named MedSR, really gives us more presence in the hospital market than we've ever had before. And I mentioned that we initially started by focusing on small practices. We now get half our revenue from larger practices, but we realize there's still a big opportunity in the hospital space. Our revenue traditionally has all been recurring revenue. So we'll sign up a practice, and we'll build them either on a SaaS basis for the software, or as a percentage of what they collect for a bundled service. MedSR typically does project-oriented work, and to us, the appeal of this acquisition was the fact that they've worked with over 100 hospitals and health systems over the last 2 years, and we see a lot of opportunity to cross-sell our software, to cross-sell our services into that marketplace. So we closed that acquisition in the beginning of June of this year. We paid $10 million for MedSR. I'd say most conservatively, we think we'll get at least $15 million of revenue a year out of the business. They feel pretty confident that they can do significantly better. So we structured this with an earnout, and if they hit their expectation to be running at a $30 million annual rate, well, guess what? They'll get paid up to another $13 million. And if they don't, well, okay, we've still paid less than 1 times revenue. So we feel like when we structure acquisitions, we need to do this in a way that makes sense for us and for our investors, as well as for the sellers. I mentioned that we bought a company named CareCloud last year, and in March of this year we rebranded the whole business. When I think about the company at the time that we went public, 75% of our revenue really came from clients who were using our services but not our technology platform. By now, over 80% of our revenue comes from technology-enabled, cloud-based solutions for the healthcare business, often bundled with services. But 80% of that revenue is really a software sale, and we thought the name CareCloud really embodies that a lot better than medical transcription billing or MTBC. And fundamentally, what differentiates us is the comprehensive solutions that we offer, a flexible approach that lets a practice determine what they want to use and what things they don't need, and really powerful cloud-based technology, state-of-the-art technology. For us, growing the business has been really core. We've grown at 44% compound annual growth rate over the last 4 years of revenue, and while we think it's impressive to grow revenue 44%, it's probably even more impressive when you think about growing profitability by 79% a year. Last year, we reported $105 million of revenue. Our guidance this year is $135 to $138 million, which is going to be 30% or more growth this year. Our Ebitda from last year to this year is going to more than double, and we think that as we continue to scale the business, we'll continue to be able to improve the profit margins. Again, as we generate profit on incremental sales, and we focus strongly on keeping the overhead down. Today, over 80% of our revenue comes from technology-enabled business solutions. Of that 80%, 52% comes from clients that are using our core technology platform. There's another 23% where clients are using one or more aspects of the technology, but maybe they're not using either our EHR or our practice management software. And a lot of that are clients that have come from Meridian, a company that we bought last year. Meridian was a piece of GE Healthcare and has a couple of technology modules that we find very useful. There's a business intelligence solution that interacts with lots of other EHRs, and so we've got a lot of practices that use Athena Health, Allscripts, or other core technology and use our BI technology. We've also have some robotic process automation that can again automate the work of the practice, automate the billing. In addition, today, maybe 8% of our revenue is pure revenue cycle management. And again, that was 75% at the time we went public. So huge transformation over the last 6 years. 9% of our revenue comes from practices where we outsource the entire management of the medical practice, where everybody from the nurses, the receptionists, all the non-physicians are our employees. And we essentially run the whole practice for the doctors. Sometimes people ask about what kind of profitability should you expect, and I caution people that the right way to look at the numbers is quarterly. There's a lot of data points, but because we've grown through so many acquisitions, when you look at the full year numbers, often those go up or down based on the timing of the last acquisition. So if you look on a quarterly basis, you'll see that we've had 45 to 50% gross margins, and then typically we'll buy a company. Margins will go down for a couple quarters as we wring out the costs, and then go back up. Last quarter we were at 42%. I would expect that you'll see the margins return to the 45% range by the end of the year, beginning of next year. On a net basis or an EBITDA basis, we were running 25% EBITDA margins before in fourth quarter of 2019, before we bought CareCloud. We reported 22% last quarter. Again, I would expect you'll see us get back to 25 and maybe even return to numbers like 30% EBITDA margins next year. And that, of course, assumes that we don't do another game-changing acquisition. And of course, we're always looking for that next game changer that can ratchet up the revenue growth. And we're comfortable with the fact that it'll depress margins for a couple of quarters as we wring out costs. If you think about our strategy, we really have three competitive advantages. We have a state-of-the-art technology platform that's cloud-based. We have a global team. We've got over 3,000 team members who are employees of offshore subsidiaries, primarily Pakistan and Sri Lanka, where the costs are 1/10 what they are here in the U.S. And that allows us to do things a lot more cost effectively. And we could also, by using our own employees overseas rather than using third parties, we provide services with a much higher level of quality. And finally, we're a proven market consolidator. We bought 17 companies since we went public in 2014, and some of them were small. Some of them over the last 2 years have been bigger. But regardless of the size, we focus on how do I remove the overhead? How do I integrate their business into ours? How do we take back work from third parties and give it to our own global team to improve the cost effectiveness as well as the quality of our services? One thing that's a little different than many companies you'll talk to is we actually have two classes of shares, both trading on NASDAQ. The reason for that, when we went public, we were small enough that we've been cautioned that it might take a while before investors warmed up to the story, and that was actually a true statement. And we decided we were not ready to sell more shares of common stock at a price that we thought was unrealistically low, and we weren't willing to use our common stock as currency in acquisitions. So about 6 years ago, we launched a non-convertible preferred, which also trades on NASDAQ, which basically pays a monthly cash dividend, but there's no convertibility. It's perpetual, so we never have to redeem it, but we actually have the right to redeem it anytime we choose at this point. And so today we've raised over $130 million through the use of the preferred stock, which sells on the marketplace at $29 or more per share, although I could redeem it at $25 per share tomorrow if we wanted to. And our view is that as our common stock has reached better levels, we're probably like most companies. We feel the stock should be trading at a higher value than it is today, but we could choose at any time to start selling common and using the proceeds to redeem the preferred. And my expectation is over the next couple of years, you're going to see us redeem the preferred. So today we've got about a $275 million enterprise value. At the point that we've redeemed the preferred, that will all be in value of the common, which would probably be a much lower valuation than many of our peers, which lets us think that over time there's some room for upside. But there's no way to predict that. But it's nice to have two classes of shares and to know that if we need cash for an acquisition, we can do so on non-dilutive terms. So why should you be interested in CareCloud? Well, it's the leading cloud-based healthcare platform combined with a low-cost offshore services team. We have record revenue growth that's driven by a combination of high single-digit organic growth as well as strategic initiatives. We have a history of doing large acquisitions, integrating the businesses to drive scale. And we've got guidance this year that will do 135 to 138 million of revenue, and that will do 22 to 25 million dollars of adjusted Ebitda. And with that, let's see if there's any questions.
We are unfortunately out of time for questions. Bill Korn is the CFO of CareCloud. Bill, a lot of information there. Thank you so much for joining the Benzinga Small Cap Healthcare Conference today.
Thanks for having me.